Good morning, good afternoon, good evening, whenever you are listening to this. My name is Alan Quinn. I am the head of brand and marketing for Cars.co.za, and welcome back to our podcast. Today, I'm very honored to have Lee Naik, who is the CEO of TransUnion Africa. Lee, welcome to our podcast.
Alan, it's wonderful to be here and with the Cars.co.za audience.
Now, Lee, I want to go into both sides of your business. You're synonymous with consumer credit and you're synonymous also with what you used to call M&M, which is the auto side of your business. But let's start with consumer credit, right? What are the major trends that you're seeing in the consumer credit market here in 2025?
Well, it's interesting. Consumer credit is quite scary. Just the word credit is scary in general because it's a tough economy. And so it's probably important to step back for a second and ask what is going on. Well, it's important to know that it's tough out there, right? And we'll get to the car sector a bit later. But from a consumer perspective, it's important to know that consumers are generally quite strained right now. At a GDP level, how our economy grows in simple terms, it's quite low. We're forecasting around 1.4 or 1.5% growth this year. And it's been quite tough on consumers. So just as for the audience, it's quite interesting to understand that about 62% of all the income we earn at a household level goes towards servicing debts. And what it means is that somebody has home loans, personal loans, vehicle asset finance, and a large part of the money we have goes towards servicing the debt. And the rest we have is what we live with. So at a consumer credit level, there's a fair bit of strain on consumers. And you got to think about the high unemployment in South Africa, well over 33%. In fact, unemployment's just gone up slightly. And that means that there's high unemployment. People want access to credit. They won't get access because they don't have employment. So it's a tough period to be in right now where those that have are doing okay, but consumers that want access to credit, that have hopes and dreams, aren't able to access it. So the data is telling us very, very simply that it's a strained consumer credit environment. Banks and lenders are generally pulling back because they need to find a way to better understand the consumer. And it's difficult if consumers aren't employed, don't have job opportunities. So it's a bit of a paradox. On one end, the vehicle sales market is going up 6 quarters in a row, but the consumer themselves remains highly indebted and needs access to credit, and they can't get as easy access as they want to.
Now, that figure you said 62% of people's income goes to servicing debt. Of that 62%, how much is asset-based and how much is not asset-based?
Well, it's interesting. You need to break up the data into different segments of people. What you'd realize as you go down the market and into the market where we have people that don't have home loans, don't have cars, inevitably they take on microfinance loans or unsecured personal loans that come at a much higher interest rates than you and I would enjoy. So you wouldn't see the balance that you expect generally across the pattern. You would find more affluent people, middle income households, will have a higher proportion being home loans that are secured, vehicle asset finance that are secured. But on the other end, you have people that are looking to use a personal loan access to buy cars, which is quite scary because you're buying an asset that does depreciate over time at a much higher interest rate. So it's a bit of a conundrum and requires us to unpack the generational behaviors that we're seeing in the marketplace.
Everyone talks about millennials coming into the market, different appetite, cars and all the rest. Are those millennials able to get asset finance?
We have found that Generation Y and Generation Z, and then the alphas, which my kids are alphas, they're 15 and 17 years of age. It's not them yet, but just older than them. These are the most positive and optimistic of South Africa. They want to get mobile, right? They have a different way to live their lives. The choices that you and I have made about brand affinity, loyalty, keeping things in a certain way, the trim levels you want on vehicle, these things aren't important. So we start to talk about generational behavior. It's important to understand as the car industry how the target consumer is behaving. For example, a Generation X is holding on to the car, whereas a Generation Y will take a really good deal if it's available. But why are they doing this? Not because they want a car, they want to be mobile. In a country where public transport infrastructure isn't as good, we want to get mobile. And any ability to start moving means there's opportunity. In fact, over the last few years, I've been studying the correlation between what we call transport poverty and financial poverty. In a market where I can't physically access opportunity, the opportunity is kept apart from me. So I try to correlate the hope in the qualitative data, what we're seeing in the quantitative data that says the majority, well over 50% of vehicle asset finance right now is coming from Generation Y and Z.
That is interesting. But do South Africans have a constructive relationship with credit and with debt?
I don't think so. I think it's getting better. So we actually measure what we call consumer credit health, right? And it's a measure we've done for over 20 years in South Africa. So what the data says to us is that health is getting better. People understand the consequence of going into bad debt, right? And typically what happens is for a consumer, we start to understand, and we've been educating consumers around what we believe is must-have debt versus may-have debt. If you've got a car that's working, should you upgrade your car because your car is perfectly fine and under warranty? There's no net new value. So there's an increase in consumer credit health. But it's important to realize that South Africa doesn't have a savings culture. We don't have excess money sitting in our check or in our savings account. So we're reliant on debt. So it's a bit of a cycle. In one hand, we understand that debt is an important element to live our lives, which is why we have a high relationship between consumers' income at a household level and debt with banks and lenders. But equally so, we have a high indebtedness level and a high impairment of debt, meaning that many people that take on their debt are struggling to make their payments. In fact, in the data we have today, we see that many consumers are struggling to make their next month's payment, close on 40% saying they can't make their next month's payment. And here's what's scary, Alan. Debt is clearly an important thing. It's somebody else's money that we've borrowed. And what we haven't realized is that it is a partnership between the consumer and the lender. And if you don't tell the lender that you owe the money to, I'm struggling to pay the money back, and actually you then go into a pattern of defaults and end up, with negativity on your credit report and on your credit profile. And my view is you'd rather talk about the challenges you have and then go into a bad debt cycle, which many consumers are scared to do. But once it's happened, it's really hard to undo.
And that negativity in your credit profile, impairments and so on, when you walk in and you want asset finance, you're asking for 200,000-300,000 rand, which is a substantive amount of money.
Yeah.
And that negativity will do what then?
Well, the negativity is actually, it's important, right? The truth is that banks and lenders are looking to understand the risk of lending you money. Now, the average vehicle asset finance is actually well over 400,000 rands now. So it's a fair amount of money. Now, when you want to apply for credit, you want access to finance, the bank has to consider a variety of things under the National Credit Act. Is Alan able to have a stable income? Are you currently overexposed to credit today? What's your ability to repay? What collateral do you have against your name? Now, clearly, if you've got yellow or red indicators against your name, it doesn't make it easy for you to have access to credit. Now, you may want the car, and the bank may want to give you credit, but in the balance of risk, they want to understand, can you pay back if we extended the credit to you? Way back in 2018, we as TransUnion released innovation to the credit space where banks and lenders were able to see whether an individual was bad but becoming better. And the corollary is also true, whether you're good becoming bad. And why is that important? In a tough marketplace where financiers, vehicle asset finance, OEMs, other dealer groups want to give you a car, we also want to understand whether people have the ability to rehabilitate. Now, as TransUnion, our view was, well, today the way decisions get made is what we call point in time. Is a person good today or bad today? But equally so, what if we could understand using behavioral sciences, right, that an individual was bad, acknowledgeably so, no problem with that, but they start to become better. And from an actuarial model perspective, could we predict when somebody could become a better customer? So you start to groom the customer that you need before they actually become the customer that's ready for you as an individual. I believe a huge part of where we are in the current pattern of our economy is that we'd have to change how we think about a customer. A customer is now fully in charge. Loyalty is dead, right? To the brand, to the car, to the trim level, to all the extras you want, and to the vehicle asset finance house. The question is, what has got to change? And I think firmly, We got to understand the personas of these customers, understand their needs and wants at an emotional level, and start to think about how we find them in their moments of truth. Because we want the perfect customer. They're not perfect. We may have to groom them to be the customer we want in future, which is a longer cycle time to get the customer. But there may be no other option if you can drive your own relevance as a traditional financier or as a traditional existing OEM in South Africa.
I love what you said, because a person can have a past. We all have a past. But if they are showing propensity to reform, you're saying that using behavioral data, you can show that, and possibly someone will then give them an opportunity they wouldn't have had in the past.
Listen, this is now something that's been in our market since 2018. We work with banks, lenders, insurers, retailers across the country. Many are starting to adopt these techniques. We call it alternative data, right? So alternative data is non-traditional data that we could get about an Alan, about a consumer. And the second thing is we call it trended data. So could we infer things in the data that's starting to trend in one or other direction? As an example, if you did have vehicle asset finance, imagine if your bank called you and said, Alan, I see that something is happening. I can see that you're starting to show signals in the data that you may struggle to make your payments in 3 months' time. Can I offer to restructure your payment? Can I offer to give you a payment holiday? Let's work with each other. In that case, the bank is winning in that you're able to retain a customer that doesn't go bad. And the customer is also winning because they're able to keep their vehicle. And the bank and the customer, the lender and the customer has found each other in their own moments of need. And I think the partnership is going to be powerful.
That sounds wonderful. But is it a fairy tale? Is a bank doing that?
Well, absolutely. I think many are doing it. And it's interesting. Not everyone's doing it. That's probably where you're going, right? You have two sides of a coin. Some people want to control their balance sheet and they want to control exposure to risk. Other people are saying, we're going to be responsible corporate citizens. We're going to find a way to drive a better life for all South Africans. How can we start to think differently about the customers? Here's the truth. We've been around in this country for 125 years. I've been in this business for just close on 9 years. When you think about this business, we haven't had a massive increase in people that have access to credit, right? In fact, today, Alan, there are about 16 million adults above the age of 18 that have no access to credit. Is it because they don't want credit? That is not true. Is it because they can't get credit? That's probably more true. And there's layers in the complexity. How do you start to see the potential in people, their hopes and dreams, and meet them there? Is it possible for all 16 million? No, it's not. Is it possible for some of that? Absolutely, yes. And we've proven it. And I'll give you a couple examples. We were able to find just recently an ability to use telco data. Now, not everybody else has credit in South Africa, but they all have access to phones. Could we use the data with your permission in how you go about your prepaid contract and infer whether you could be suitable to get a personal loan or get a cheap car, right? And we found actually it is possible. And now to your next question, have you tested this and have you found a pattern of believability? The answer is yes. It is possible that if we change how we see a consumer, a potential customer, you could find growth. In fact, in the specific model we built, right, we found that for all of these customers that never had access to credit, by using a new way of considering the behavior, the patterns of data, you could find an increase in 20% of approvals by adopting this new technique. Is it possible? Absolutely yes. It doesn't mean that everybody will want to do it because it changes your risk pattern, your risk policy. But if you want to grow and survive what is a very disruptive marketplace with AI and e-commerce players, how do you change how you shop as a traditional player? The threat is not on the digital players. They got nothing to lose. It's our traditional businesses, banks, lenders, OEMs that have to disrupt themselves to drive their relevance.
I've met credit committees because I used to be in a bank. The idea of increasing your approval rate by 20%, that sounds alien. But you're saying possible. Now, we're talking products here. Would that be at a sort of more personal loan level of product? Or are you talking the top end of asset finance as well?
We have examples over this probably 7 or 8 years of us having done this kind of technology. We call it alt database scores. 2 of the lenders that do small to medium enterprise loans has growth in excess of 10% a year, whereas the other banks have low single digits for the exact same product category. And I know full well who's using these new techniques and who doesn't use the new techniques. So clearly, these lenders that are using these new techniques are running good business via the risk committees that you presented to. But it requires a leap of faith to test and validate these things. So you asked the question, what kind of product sets? Well, the reason we always start at the bottom end of financial inclusion, and that means starting with a retail account or a personal account, it's the one that's less risky for the financier. We want to build up your credit. So whether it's a retail card in a store account or a clothing account, the ability to give you credit in a controlled manner and you build up your ability to get in more credit is how we do it. So our approach is to find customers to enter financial inclusion as opposed to saying, give them a car and hope and pray. Hope and pray isn't something you can model. You can, however, model in a controlled fashion, bringing somebody into the financial inclusion continuum and over a period of time modeling the behaviors you want.
I will definitely get you back for another podcast to talk about how you build up that credit. Because I did it with my son recently, and he waltzed in about a few months ago with a Chinese car, which he was very proud of, and it was actually a lovely product.
How old is your son, if I could ask?
He's 24.
Now, it's really interesting, and maybe that's just the point to make. Your son, and maybe you figured this out before me telling you, your son has a different approach to how he lives his life than how you do, right? How he thinks about mobility, cars, the engine, the lack of an engine, if it's an NEV. Your son has a different approach. And your example actually is quite powerful because your son is a proxy for the growth of our industry and our economy comes from.
And it's just the love of technology. Because the Chinese cars, I always characterize Chinese cars are technology rich. Maybe not so great about some of the mechanical elements, but they're technology rich. And him being young and an early adopter, that's just a real target market. But you've seen this Chinese influx of cars.
Yeah, absolutely. Well, listen, 3 years ago, the Chinese vehicles made up like 3% of the market. And now it's close on 14 to 15% of market share. So clearly there's been a flood of these vehicles. And it's really interesting because people always ask me, when did it start? And I thought to myself about my own journey of buying cars. Now, I am extremely brand loyal. In fact, in all my time buying cars, I've only ever had the same brand. I'm that loyal.
Which is it? Come on, Lee.
No, it's crazy. I got to protect all my friends in the OEM industry. But more importantly, though, I'm not a proxy for what the future looks like, right? If you think about when did things change, it is my hypothesis that things change in my own life, right? In the COVID pandemic. Everything about how I approach materialistic things, because in the COVID pandemic, what are you thinking about? Am I going to survive this? How do I get food to my house? How do I buy things and have it delivered to my house? Can I return it for free? And the industries that did really well at the time are the people that disrupted themselves to allow marketplaces to come into their own. The Take-A-Lots, the Mr. Deliveries, the Zandos, the Superbalist. Those models tended to thrive. But what really happened, and as a brand and marketing guy, this is probably another chat for another day, but I believe that the Allens of the world lost control of the customer in the pandemic. For the first time ever, we didn't own the customer. They owned themselves. They refused to leave their houses, hid under desks, right? And all they wanted was food and safety and medicine. And so the customer is king, the customer is queen. And suddenly what is important pre-pandemic, like having a luxury vehicle, the best German or Japanese vehicle, that has now changed. And we've seen in the data itself that the hypothesis has held true. People, specifically older folk in the Gen X range, and baby boomers, they've been loath to change their vehicles. They view us, well, actually, I've always had 2 vehicles, but actually, we actually could drop each other off on the way to work. Drop off the kids, drop off the wife, or the wife drops the husband off. And we've seen a clear pattern of going from 2-car households to 1-car households. And guess what? They've gone from sedan vehicles to mid-sized crossovers and SUVs. And not just now, for the last 3 years. And people are keeping their cars now for 6 to 8 years. It's all in the data. So the hypothesis of when we lost control is largely true back in 2019. So the group that you and I belong to, Alan, we decided to change how we approach materialistic things. We're thinking about the fragility of humanity. Do I need a car? Don't need a car. Whereas your son is thinking, actually, that car comes with a lot of cool features. It'll mostly work. Or the car comes with unlimited engine warranty. That sounds amazing, Dad. I'm going to take the car. What does he have to lose, right? And more importantly, he believes that the car is cheap enough that if he makes a bad decision, he can recover. Because the entry level price of an SUV that's Chinese is like 150,000 Rand cheaper than an equivalent traditional SUV. So the entry point is a lot cheaper and becoming even cheaper, given how the integrated value chain of the Chinese marketplace works.
Now, you mentioned that the average vehicle finance loan is now 400,000. Did I fall asleep for 2 years and suddenly people got richer? Where does that stat come from?
Well, people have not gotten richer. What's interesting, and this COVID pandemic is a pivotal moment in the conversation. You would remember back in the pandemic that there was a lack of chips, silicon chips that go into cars and computers. And if you study the entire car market, it works in cycles of people buy used car vehicles and new car vehicles in the next cycle. We're actually right now firmly in new car sales territory. We actually measure in something called the Vehicle Pricing Index at TransUnion for 2 decades now, the correlation between used cars and new cars. For a long time in the previous cycle, used cars is what people wanted for a couple of reasons. One, you couldn't get as many new cars for a long period of time. There was delays in getting them. And the used cars were available. Actually, well, the used car is still fine. It hasn't broken. Let me keep it for longer. Or let me look at Cars.co.za and find a used car that I could buy that gives me what I needed. I don't need the shine of a new car. So what we then saw was there's a huge pressure on finding used car stock, and the used car price had a higher inflation than actually new car prices, which had no availability, right? So what happens and the cycle then starts? We're now entering a new cycle, and we're in the cycle right now because NAMSA has reported almost 6 quarters of vehicle increase in sales. And as I mentioned, the Chinese vehicles make up some 14 to 15% of the market. And as they've come on board, they've introduced prices at a much lower level. So if we chat a quarter from now, which I hope we'll do, it will talk about that number. Lee has dropped. And if we start to see what we're seeing today, like with your son, that number will start to ratchet down unless Dad is funding the car or your son has saved up money, has the collateral elsewhere to not fund it using vehicle asset finance. And the data is always phenomenal. As a data guy, I really love understanding what's going on. We've seen a pattern right now, Alan, where the new car sales has gone up, but the number of vehicle asset finance deals hasn't gone up as much, right? If they're going up in terms of sales, what's happening? Did they trade down their car? Possible. They had a car that had some equity left in it, and they bought a cheaper vehicle, a Chinese vehicle, maybe another vehicle. Maybe they used a non-vehicle asset finance vehicle because youngsters, like your son, want instant gratification. They want speed to value. They didn't bother walking into a dealership. They bought the car on an online platform, and it showed up at their house 5 days later. It is absolutely possible. Right? So we've got to understand how people think and understand how the new set of behaviors, specifically, I call the generational shifts, are happening. And when we understand how the shifts are happening, you will see a correlation in the market shares as you go forward. You see a correlation to the average finance value of a vehicle and the type of vehicle, the mode of the vehicle. It's really interesting. If I said to people, do you believe me when I say that most people wanting to buy a mid-size crossover SUV, they'll say yes. Because people have realized over the last 5 years, there's more utility in a mid-size crossover than having a sedan or a 2-seater vehicle. It's a reality of a world that's changed post-pandemic.
I always feel that people buy SUVs because they're scared of our roads, and you just feel safer when you're a little bit farther from the pothole.
Well, that's not totally incorrect. I think we do have challenges with our infrastructure, as I've mentioned. And if you can get me into a vehicle that's as cheap as a sedan, why wouldn't I take it? And it's interesting, I mentioned earlier as a brand and marketing guy that we stopped looking at billboards and listening to radio adverts in the pandemic because we focus on our health. But now billboards are popping up everywhere. And which brands are they? It's the Chinese brands. in your face saying to you, here's your unlimited warranty, here's your 20 years of this, here's your free year of fuel. So there's a lot of provocation in your face saying, do you really not want to change your car, right? Isn't this really appetizing? Isn't this really appealing to you? So the customer is king, the customer is queen. And in their context, it may not matter what we're offering them because they're looking for something different.
We had, now in the question of accessibility, we had Van der Walt here from To Be By Cars, and he spoke about their venture with Capitec and purpose-driven lending. And it was very interesting because if you look at asset finance, there's restrictions on the age of the car. And if you look at what We Buy Cars sell, a lot of cars are older than that. And it sounded very exciting what he was saying in terms of how that sort of purpose-driven lending type products, which are personal loans with a new wrapper on them, are actually providing a lot of accessibility. Are you seeing growth in those kind of products?
Well, that's really interesting. So earlier I spoke about a lack of correlation between new car sales and the same correlation in the increase in vehicle asset finance. And the question was, where's the money coming from? And so purpose-driven lending, as Farn has put it, is a variant on what one could do to access financing. Now, of course, as you think about personal loans and microfinance, it comes with much higher interest rate, right? But for customers that struggle to get mainstream banking at the bank of their choice, they may be more open to buying a car via another establishment able to give them access to finance. And it's a weighing up thing, Alan. On one hand, you want access to better financing, better interest rates. But if you can't get it in places that you think you should get it, then who are the other alternates? And what you're seeing in the example you've given us is that traditional players are starting to disrupt the marketplace. New players are disrupting because traditional players aren't disrupting as fast as they should. So how do you respond? And I think it's a provocation. The consumer should win. But as someone that runs the largest credit bureau in the continent, it's important to say that one of the things I worry about is the consumer's credit health, right? In accessing higher interest-bearing loan products, in accessing vehicles such as buy now, pay later, which you can now do on online purchases, clothing purchases, you start to ratchet up more commitments every month. And you don't remember that you are highly indebted to start with. And a single change, a small interest rate blip up, right, may actually put you into a spot of bother. And earlier you asked me, do customers really know what's going on? Not really, because not everybody wants to hear bad news. And as a credit bureau, we see a level of impairment that grows because people don't look after their credit. We always say that knowledge is power. And for you to be empowered, you need to access the knowledge in your credit report, in your bank statements, in your accounts. You got to want to take control because in the end, you are in charge of your wellness, whether it's physical wellness, spiritual wellness, or your financial wellness. You got to take charge of that.
Now, one last product I want to talk to you about, subscription services. You hear this word a lot. LinkedIn, people in banks, they talk about it. Is it really growing? Because there has been subscription services in the vehicle market for a long time. And you're talking very much the lower end of the market, people who can't get access to credit, and they're taking subscription services.
Yeah.
But is that evolving? Is it changing?
I think we should actually elevate the conversation to the category called mobility as a service, right? Which is, per your definition of subscription, meaning it's a basis of partial payments for a period of time that's not typical, it's atypical. And we've seen a lot of disruption in the space. A lot of the traditional players have actually opened up lease-based agreements where you can buy a car for a period of time. We've had new entrants as well, but you have a traditional player spinning up facilities to buy mobility as a service. So it's definitely on the increase. But why I say it's important to look at the broader category called MAAS, it's because people want to get mobile. Remember the correlation between transport poverty and financial poverty? We want to get up and running. We want to get moving again, which is why on the road, you see a lot more of these little Bajajas running around, right? Tiny as anything. And we see even the Lyfts and the Ubers and the Bolt have even cheaper variants of pricing to get you into a car. because the consumer, once again, wants to be moving. They want to be in charge. And this point about we care about different things right now provokes the conversation to the sharing economy players, the Ubers, the Lyfts, the Bolts, kind of offer cheaper variants to get people moving. Do I care whether the car is aircon or not? Not really. I want to get moving. For the players that want to move the inventory sitting on their warehouse floors, so the traditional players have inventory sitting around they can't move. But what if you change your business model? What if I offered you a lease to buy option? What if I offered you a balloon-free payment, no deposit model? What I offered you a 1-year option, a guaranteed buyback? These are all variants in the continuum we call mobility as a service, because we got to change the way we show up to the consumer. A highly indebted consumer, a consumer that's not brand loyal anymore, a consumer that may have shifting financial wealth patterns. We're going to find a way to meet them in their moment of truth. And I think that's the provocation. Earlier, you talked about the risk committees that you presented to. Well, the same risk committees have to ask the question, is it okay to not grow in the marketplace? Because we can't grow, we have to cut costs to have viable businesses. And if others are disrupting and finding growth, can we learn? You made the point earlier. If somebody else is winning and I'm losing, let me look at how they're doing and let me emulate it. If I just hope and pray that things return to the way they did in 2015, it won't. It won't.
All the risk committees I presented to, a growth mindset was not something I encountered. But that's a different story.
Absolutely. Absolutely.
But now let's circle back to DealerKon, because the reason we're here is DealerKon. Now, you're one of the sponsors of DealerKon, one of the major sponsors of DealerKon. What does TransUnion, what does Lee want to see at DealerKon? What do you want to achieve from that day? 17th of September, Santon Convention Centre, don't forget. What is it you need from that day?
Well, for me, it's important to recognize that the world has changed. A large part of our conversation today has been around generational behaviors, about digital, about data, about the youngsters, right? And it's my very, very clear preference that the world will be driven on the front end by e-commerce and digital. It's very, very clear in how people are buying cars. People are looking at TikTok and driving their car buying decisions. So for me, I want to understand how by coming together with Cars.co.za, we start to show insights at DealerKon for the first time to the OEMs, to the dealers, the NAMSA and NADA leadership on what we're starting to see that may give us patterns that will allow us to have better strategies of how we drive our relevance. What we really want, Alan, is in a market for the auto industry that makes up some 5% of the GDP, that now is under the pressure of tariffs from the US, we want to see that industry survive and thrive going forward. Can we find new patterns to provoke things like mobility as a service, the focus on new generational patterns, buying cars in new ways? That's what I'm hoping to do. So by coming together with Cars.co.za and combining our insights and perspectives, we're hoping that that is something we can put forward to what we hope will be a really large audience.
I'm fascinated. You even mentioned the word TikTok. You're the first person to sit opposite me who seems to know what TikTok is. Yeah. I'm a huge TikTok fanboy. It's Cars. It's our highest growth channel.
That's right.
And people need to learn how people access information. And TikTok's a huge source of information in South Africa.
It is so interesting. And, so TikTok is almost the 15-second version. But what is before TikTok? In my mind, it was the 140-character tweet, or the X right now, then the 280 character. And now it's down to, if you can't say it in 15 seconds, you can't say it. Of course, there's longer form TikTok as well. But how do you get to the customer that's really busy? And we keep calling it this moment of truth, this time when they need to do it. People don't buy cars in 8 to 5s anymore. They buy it when they have time to get round to buying a car. It could be at 2 a.m, 3 a.m, it could be on a weekend, it could be at a conversation. People share these TikToks, and it's really interesting. In our last study, we found that people that do buy cars, and we actually have the actual data, some 76% of customers saw adverts on TikTok before they bought their car. Mm-hmm. Now, what we're hoping to share at DealerKon is some correlation to what you're seeing on Cars.co.za and what we see on our bureau and on our vehicle asset businesses and bring them together, because we've been studying this industry for 60 years. And my view is that this industry is being disrupted. If you haven't caught the memo yet, we're going to tell you about it at DealerKon, so look forward to that.
People always ask, how can I get my product proposition across in 15 to 30 seconds? Actually, as consumers, all our lives, we've been making up our mind about things in 15 and 30 seconds. And then patiently waiting for the other person to stop talking so that we could tell them what we've decided.
You know, it's interesting. I know your background, very similar to mine, comes from the consulting area. And we were taught as youngsters, when we were 20s, right? If you can't say it in a minute, you can't say it, right? And now the provocation is if you can't say it 15 seconds, you can't say it. And throughout my own personal career, I've gone to meetings where the meeting ran 15 minutes late. So can you say it in 10 minutes or can you wait 4 months to reschedule the meeting? I think it's the evolution of how people think and the busyness of our days and our lives. We need to find a way to, I keep saying it, meet the customer halfway. But equally so, one of the things we often talk about is the language or the tone and mode of communication. So here, we know the customer's got no time. They're worried about their busy lives. We know that they can't physically get to you sometime. Can you get to them in their preference of channel? Is it WhatsApp? Is it TikTok? Is it Twitter? Is it LinkedIn? And listen, there's a confluence and a convergence of approaches. We always talk about omni-channel being something we should all do. But there's no clear bias to the fact that that device in your hand is where it all starts. And the social media platform of choice appears to be the ones that have shorter form content and not longer form, because even Alan doesn't have 2 minutes to watch a video these days.
Lee, it's been absolutely wonderful to have you here. As I said, we must get you back because I want to delve more into this consumer credit question and how people can understand and interpret their own credit reports. Fantastic to have you, and I will see you again 17th of September, Stanton Convention Centre, DealerKon.
Well, it should be amazing. I'm looking forward to the 17th, and I think partnering with Cars.co.za should reveal some really interesting insights. And I think the big word I want to leave the industry with is provocation, right? Earlier we spoke about how there's disruption happening. Either we catch up and beat the disruption, or we get left behind. And hopefully by putting forward DealerKon in the format we have, hopefully we can give the provocation and the insights needed for the attendees to go away and actually change and disrupt their own businesses. So thank you for the opportunity.
The Cars.co.za DealerKon is taking place on the 17th of September 2025 at the Stanton International Convention Center. Facilitated by Fifi Peters and Aki Anastasio, an inspirational keynote addressed by Vusi Tembekweyo, and you will learn from top CEOs and industry leaders.
Processes within the traditional dealership that took long are now becoming a much shorter period.
Dealers need to be adaptable and well informed and well educated on not just what the consumer knows, but be seen to be an expert in their spaces.
Knowledge truly is power, and you'll be able to apply that and maybe sell that extra car.
Future-proof your dealership with data-backed insights from the Cars.co.za industry report powered by TransUnion. South Africa's most influential dealers, OEMs, FNIs, and banks will gather to share ideas, solve challenges, and build the future of automotive retail together. In just one day, you'll meet industry leaders who are shaping tomorrow and explore the strategies that will keep your dealership competitive. DealerKon is your competitive edge. Secure your tickets now at dealerkon.cars.co.za.